All right, good evening, ladies and gentlemen. This is Clueless A Trading Frank. Actually, just hold on for one quick second. Let me just get one thing right, and just hold on to your hats for about 60 seconds. Okay, I'm back. All right, let's start off this thing. Okay, everyone there? Let me take a quick roll call. As far as I can see, we have Alec, we have Exita, Sharv, Jasco, Jules, House, and Nia Richie, correct?
Yep.
Okay, everyone can hear and hopefully see the screens. That's the whole point of this quick webinar update. So, all right, first of all, today is as always, I lose track of time. Today is the 12th of October, middle of the month volatility that I talked about weeks, months ago. It's approximately 5:09 p.m. Eastern Standard Time. This is a quick market update webinar explaining a few of the things that I've been showing all week, and a quick forecast on things that are about to come. Full disclosure, this is purely for financial education and not for any solicitation or advice. So let's kick off. Let me just make a couple of comments like I always do before I start these webinars. I'll keep this short and straight to the point. This is probably, and this month of October, especially the first half of October, is probably one of the most confusing, frustrating, and difficult times to trade on a consistent basis, regardless of what the charts are, regardless of whether we're seeing a technical breakout or whether we're seeing a breakdown, whatever the case, both ways, long and short, unless somebody is committed to a certain bias, both long and short trades, if somebody is looking for a binary outcome, in other words, a straight line move up or a straight line move down, unless you just do those tactical moves up and down, as you see behind the screen, as you know from my charts, people are just going to get screwed. Excuse my French. Okay, just the way it is. We have a lot of negatives in the market, and that is already, in my opinion, priced in, and that's the reason why we're sitting here or at fighting to get above the pivots and sitting here at 2130, 2139 to be specific. That's what the closing value was on the S&P 500 and not at 2190. So I've always, as I've done this for years now, and I've walked people through a lot of difficult situations, including myself. That is a very frustrating experience, no question about it. Now, tactical traders who are looking to make a couple of quick points on SPX or RUTs, they're rewarded. There's no question about that. But when they leave swings open, despite what it looks like, what it might look like, on that particular day, it just doesn't work out. But if you bought a tactical low like we did yesterday at around the 21-22 level, for example, on the E-minis and the S&P 500, it was around 21-28. Then you got a nice bump on it because at one point in the day, earlier in the day, we're up to 21.45, and then after the Fed, we had that spike which went up to about 21.45. We never reached that 21.50 level, so that's a good solid. That's a good solid 17 points that one could have had. Now it doesn't happen in a straight line. This is the daily chart. Of course, if I make this on an hourly, you can start to see this is where we put the alerts out. You got a nice. Somebody please mute the mics. And then by and then by the end of the day yesterday, we had a nice, powerful move. And then Wednesday we went up as high as 21.43, and then all the way up here to 21.45. So there was some profits to be taken. There were individual stocks which went up on the moves in the market, but then you know what happens. This is a market where I'm seeing a bunch of greens and I'm seeing a whole lot of reds, but I'm seeing a bifurcated market. So what I'm getting at is that I don't know how you guys do it, but you gotta somehow or the other manage your positions where you're not lopsided thinking, oh my God, here we are where we're starting to break out. It looks fantastic till here it was all green till 2 o'clock looks like it was going to break out over this line here and move higher, but bang, right there you get a reversal candle. So the only way that one can manage their tactical trades, which are basically the short-term trades, whether it be on Amazon, whether it be on Tesla, whether it be on Netflix or SPX or RUT, is you have to, on your own screens, track what's happening behind the scenes, which control what's going to happen to your stock prices in the front side on the stage. And that is the E-minis or the Russell 2000. Now the Russell 2000 moves on a slightly different tune at times. It moves primarily on oil. Okay. And somebody's texting me, do we have the link? I mean, this is... One second. Let me try to help. Maybe that person's already walking in. Yeah, probably walking in. Okay. So what happens is you got to manage your trades with whatever amount of contracts that you have, or you're trading an individual stock like Buffalo Wild Wings, which paid the bills nicely, nothing great, but hey, from the swing trade, it was a fantastic trade. So, but then just as we're tracking the charts, it hit the upper end of, almost hit the upper end of the channel, and then it pulled back. Nothing really changed on a swing trade. But on a short-term basis, could have made yourself a little bit of money. The stock was alerted at around 136, and then at 137, the stock went to 141 roughly, and then pulled back to about 139. It's just the nature of the business, the way it works. On a swing basis, I think it works fantastic. We'll see. But for short-term traders who are looking to scalp some profits, they have to look at their own screens. And I know a lot of you do, and a lot of you don't, because there's no way possible in the volatility-driven markets that we trade in and that we live in that we are going to basically be able to notify everyone on a minute-by-minute or 5, 10, 15-minute basis as to what's going on. It's just not possible, and my service is not designed to do that. But there are enough tactical charts put in place where you can basically look at your own screens and decide what you need to do. So saying all that, at this point, we have mixed signals and some very powerful positive signals on the swing side. I know for a fact, and this is just my opinion based on years of experience, that once the middle of October crosses over, okay, we are going to see a pretty powerful move up towards the upper end of the range in the markets. It is also possible that doesn't happen this year, but it's also very possible that it does happen. Now, when we say upper end of the moves, I'm not shooting for the moon and saying, okay, we're going to go to 2200, 2190 and all that stuff. I'm basically saying we have a good shot from this level where we're at to move up towards 100 to 200 points. Look at the daily here. That we got a good shot here, given the internals, which are some of the most deeply sold, extreme oversold that I've seen in a long time, that we have a good shot from a volatility standpoint to move up and at least retest this downtrend and the 50-day moving average at around 2165. Some of you, a lot of you guys know exactly, members know exactly what I'm talking about. You got about 40 points from here. I'm sorry, you got about 30 points from here. Multiply that by 7. You're talking about a 210 plus move point on the Dow Jones Industrial Average, bringing us up to roughly around 18,450 on the Dow Jones Industrial Average. Somebody might say there's no way possible that can happen. I can show you it's yay way possible. It happened because we have done it many, many times. Now, here's the other important fact. I constantly keep on looking at charts for my benefit and all of your benefits to look for candle patterns. Candle patterns and identifying them is easy if you have an open mind. The problem is that in general, a retail trader does not have an open mind. Their basis on what they're looking at is based on their cognitive bias. So without using too much fancy terms, the cognitive bias is, are they bullish or bearish? Are they listening to a heck of a lot of guys on other forums? Are they listening to a lot of the media? Are they feeling the pains of some of their short-term losses? So that changes their outlook on the market. I can't help you with that. That's something that you'll have to just figure out on your own. Because when people lose money, which we all do at times, they change their bias on the market. They start to feel bearish. Now, a lot of traders, which I keep on constantly saying, don't want to admit that. They all think they're robots. They are not. They are nothing but soft individuals and human beings who tend to think with their heart and not with their brains. A very hard thing to do. Believe me, I deal with it every day because this is money we're dealing with. We're not paper trading here. So we make some very stupid decisions. So saying all that, let me show you one pattern that might, somebody please mute their mic. Looks like they're, either slurping coffee or, blowing their nose. Thanks. Can somebody please mute their mic? Whoever's mic is open. Oh. MJ, how do you mute your mic? Okay, don't worry about that. Just, how do you mute your mic? Look on the right-hand corner of your screen, and you'll see a mic button, and then you hit, you hit that. Good. All right. And that's a valid question, by the way, because the computers are not designed to mute mics, That's just the way it is. So that's it. All right. So what's going on here is a couple of very important, this is S&P 500. All right. So what's going on here is a fight between the machines, the so-called E-mini traders. Every trader that I read, and I scour a lot of different forums, all right? StockTwits is one of them. They all seem to be gurus on knowing exactly what's going to happen, And that's all good Conviction is good, but I also find that a majority of them are uber bearish for either political reasons or for emotional reasons or for whatever reason that they have. And the main reason is their position short. So people who are positioned short, people who are positioned short in any large way, which I'm sure they were not right at this point here, are cheering for the markets to completely collapse. It doesn't happen like that, because one of the simplest lessons that I've learned in my life is that when something gets too easy on one side, the market goes the other way. Pure and simple. That's just the way it is. So at this point, if many traders are starting to think that, hey, it's just an easy low, that we're just going to crash and burn, the markets will do otherwise. So when you get those tactical big moves up, we want to be in a position to take advantage of them on that reflex bounce and then short as needed up the road. Some people might say, hey, listen, you got a great sense on what's happening with the market, so why the heck didn't you short this candle? The reason I didn't short the candle, and this is a question I asked myself, because I'm a straightforward, honest guy when it comes to it, okay, is because it was hitting such deep oversold levels on every single front. I didn't have the courage, and I'll be the first one to tell you, to really move in that fast and short. I should have. I've done it before. So that's the only reason. Because when you're trying to short a waterfall decline in a market, you better make sure that you are ready to act pretty fast, because when that reflex bounce comes, it's going to be fast and furious. Now, some traders who are newer to the game or just said, hey, what the hell, I'm going with my gut, I'm just going to short the market. Yes, they did very well on that particular site, on that instance. And they think they're just heroes, which is fine. Confidence is built from being stupid, and also from built from being smart. In other words, you could do a very stupid, trade that's based on a gut feeling, and it works out, and you think you're a genius. It doesn't work like that. Yes, on that trade it did well, and we're happy about that. So the point is that don't let your confidence come in a way, both on the short side or the long side, so you think that that it's just going to work out because that's just the way it's going. Just when it gets too easy, they're going to slam the market to the upside, and you're going to get burned. So that's the sole reason why I didn't go, other than small tactical shorts here and there on that side, didn't go heavy short. I would love to go heavy short right now, but I'm scared that if I do that, I'm going to basically get whooped to the point where it's not even funny. So saying all that, let's see what exactly is going on. And that's really a simplistic but honest explanation of what the behavioral explanation of why one should be careful before they get a little too confident on one side or another. But I do notice one thing which stops me from going overtly bearish at this point is the fact that so many are dogmatically bearish at this point. You don't believe me? Ask yourself. Ask, go look at other forums. They all are. So, saying all that, I have what I try to do every day, as you all know, is I try to put in all these different patterns and indicators out there, so which gives me an idea of what might be going on underneath the surface. And underneath the surface, believe it or not, there's smart money buying this market. All right? Because I'm seeing that happen in the form of the stochastics, in the form of this and that. It doesn't always have to happen on a 1 hour basis or a 4 hour basis, but that's what they're doing. Now, whether they're doing that for a 100-point move or a 500-point move, I have no frigging idea. But I'm seeing that. So let me show you a couple of them which might shed some light and validity to what I'm saying before we cover the externals, which are the chart patterns. So number one, let's take a look at the fast stochastics on the Thinkorswim. On this particular computer, I'm doing the webinar. I do not have access to my Quads platform, which runs on my other supercomputer out there on the right hand side, okay? But I'll show you the charts that I've been posting all day long. So here we have a couple of things going on. We are back. We were down here during that big crash, Brexit crash. This wasn't even Brexit. I'm sorry. This was Brexit. Okay, and look where we are with, and this was the last crash that we got, which was only a month ago, literally a month ago in September. So right there, and we are right now pretty much at around the same levels, give or take about maybe 50 or 60 points. We are starting to create a minor positive divergence. This is known as a positive divergence, where for the same price levels, approximately, you are creating a higher low on the internals. The internals on the market are simply the heartbeat of what is happening. And it's your blood pressure, it's your EKG, it's your cholesterol level, whatever you call it. Okay, a person might look very sick and be very healthy, or a person might look reasonably healthy and still be very sick, right? So it's just the same thing with internals of the market. I try to read them as much as I can, and the closer I read them, the more noisier it gets. That's what I'm talking about, the volatility on an intraday basis. There's no way that somebody can call it. Okay, so saying all that, okay, MJ's sound isn't working at all. Okay, all right, no problem. It'll be in recording anyway. So here we have a minor positive divergence. This particular little turn that we saw today, and this is on the daily, so it cuts out a lot of the noise that we see on an intraday basis, might evolve into a sharp move higher. We don't know yet. Or it might evolve into a, let me get the drawing tool here, or it might do this and create a very deep, right there in that zero level of a large double bottom. Okay, we don't know yet. So that's why I'm saying that you got to keep your trades close to the vest and not expect just straight line ups and downs. If we start to move from here, and a lot of these things happen overnight, if we start to move from here, then it's going to be rather quick. I want to mention one thing. The large drop that we saw on the markets just in the past, this particular heavy duty move down, obviously nothing to do with technicals, has to do with just pure money management, has created some large margin calls. You know, having worked on Wall Street for a heck of a lot of years, but you guys know it better than I do. You don't need to work on Wall Street to figure that out, that a good amount of people use margin. And hedge funds use a large amount of margin. In the old days, they used 30 to 1. For every $1,000, they could borrow another 29,000. Now, I believe on a conservative basis, they use 6 to 1 or even 8 to 1. It's still a lot. So for every $10,000, they can trade with 80,000 bucks. If things go the wrong way, they got to basically, you know, sell fast or come up with a margin call. And those margin calls are manifest themselves in intraday sell-offs, which a lot of people don't realize. That's exactly the reason why it happens. So let me get this out here. Bingo. All right. So saying all that, so that's what I'm starting to see here. Now, let's take a look at the McClellan oscillator, which I give a lot of weighting to, because the McClellan oscillators are only good, ladies and gentlemen, during times of large volatility. That's when you can start to read them hard. So, and these McClellan oscillators don't necessarily move very fast, especially on the dailies. But what I'm noticing on the dailies here, let me just refresh the daily chart. And this is primarily for people looking out towards the end of the month. I just want to be clear about that, okay? I just want to be clear about that. Not looking out for the next 5 minutes. Is the McClellan oscillators are starting to see a shrinkage. We were as low as we were during the crash on the first part of September, and during Brexit. During Brexit, we had reached a low on the daily. You can see that on the right-hand side of 100, and I'm rounding off the decimal, of negative 167. These are horrendously low numbers. During this particular crash, which resolved itself on making, into a powerful move up, but took a whole bunch of days, which seemed like eternity when people are waiting for quick trades. And that includes me. 1, 2, 3, 4, 5, 6, 7, and then bang, bang. So this little triangle was resolved upside. So, and we did all that. We walked through people out of that. It doesn't mean you're going to catch every single move. It simply means you're going to try to track it and figure out what's happening underneath the surface. So when we got this big crash down, we went down as low as minus 153, and then on the third day, and this was the follow-through day. On the third day, we actually went to minus 189. Minus 189 is when you buy things hands down. I mean buy things hands down. Just sit there. Now you decide what you want to do. Here is pretty good too. On a short-term basis, getting to minus 160 means there's some pretty heavy-duty capitulation. I talked about it yesterday. I want to remind everyone, you have all 11 sectors in the Dow Jones Industrial Average way down. You have a 9-to-1 down day, normally considered a tradable bottom, which on a minor technical basis was, because we went up from being down, what was it? We were down about 240 points yesterday or something, right? We ended down 196, then we went up about 50 points today. So do the math. We actually gained 100 points from the lows of yesterday. Saying all that, you got a lot of severe readings going on here. Now, unless something is really rotten and we're going through a 2008, 2009 type of scenario where everything is going to fall apart, which I don't think is the case, and that's where I leave it to my judgment to figure this out. I'm not asking you guys to buy this stuff, okay? But I don't think there is a credit crisis going on right now. Markets fall apart and don't look back and look up for months in a row unless there is a credit crisis. We don't seem to have one. Yes, we have a lot of political BS going out there, okay? Some people telling us that we're finished, that everything is just a house of cards. Well, I've been hearing that since 2009. In fact, I've been hearing that since 1998, okay? So you guys figure out where the markets come from there. Markets have their own life. American business is the one who decides how they're going to control their expenses and what they're going to do with their income. Political views aside, which many traders seem to incorporate in their trading, you're not going to get anywhere with that. We're trading numbers and we're trading what we're seeing. So saying all that, this is starting to shrink. If you start to see this line, and you can track this on your own screens, and I have that new term now, right? MOOS, monitor on own screens. So I don't have to type it all in. So basically, if you start to see the histogram shrinking, despite the volatility in the market, you know at one point, whether it be Friday, whether it be Monday, whether it be Tuesday, you're going to get one of those 200 to 300 point days coming your way. It's the simplest way of figuring it out, because that's exactly what the algos do. They never raise a green flag and say, okay, buy the heck out of me because, everything is oversold. No. They'll go back and forth. They'll go back and forth. You have to keep on watching the internals. If you start to see this line here on the daily starting to creep up, because at one point it's going to get overbought again. And it seems like this is the level before it gets overbought is when most retail traders start to get uber excited. And that's why I basically sell everything and start to put out some shorts. And I have a difficult time many times, which a lot of you know, trying to put my alerts and get people to get involved on the short side, or put hedges out, as I like to call it, because they seem to be too excited because the markets are moving higher. It is a critical mistake. Please remember that. Please remember that, because this is not the old-fashioned market or grandpa's market, okay? When the markets are getting overbought to levels, don't go out there and just buy just because the prices are looking for another breakout, because they'll hit you right there. And it always happens. even happened on this round of the sell-off because both the fast and slow stochastics were in the overbought zone. It was my mistake. I will admit that. It was my mistake that I didn't go heavily short because both the lines weren't curling down. They were still shooting up, but they were in overbought zone, and that was right. That was right before the drop on the 11th, and this was the day, the 10th. They were all the way up there, and that's already posted. So if somebody, and remember, this is another important thing for all of you. You don't necessarily need to follow. You can go against the grain and say, listen, this is the way he's talking about, but he doesn't seem to be putting on his shorts. You do put your shorts out. You don't need to wait for me to tell you. And some of you do that and do very well at times. So use me as a resource, both on the long and short side. You don't have to follow me because I'm not God. So I might be taking down positions and just playing around with the lottos and stuff to minimize my risk of loss. And just because I'm getting into a position doesn't mean I'm getting a second mortgage on the house and putting it in there. I'm playing around with small amount of money. JB, our member, asked me like, hey, this seems like there's a lot of lottos. He said that on Friday. I said, yes, because we're coming in the middle of October. So even if I blow up on those lottos, it's not going to put me down on the street. That's it. That's just the way it goes. So just because I'm taking a position doesn't mean I'm putting in thousands and thousands and thousands of dollars in that particular option strike. So, it's pretty simple. That's called, managing your own trades all about. So saying all that, we're going to monitor this if this is shrinking on the daily, if that's for swing traders, and whether or not the stochastics, this is the fast stochastics, are starting to rise. Saying all that, there are many different ways to look at this market. Number one, this is not a traditional market. I know I keep on saying that as a broken record, but I will keep on saying that. But the point, and the point is, it could be that we have a situation like this, and I've showed that on two charts that I've posted since yesterday. It could be that we're creating a dragon bullish formation. However, that could mean that we have another 19 points on the downside to test this big double blue line, which was the multi-year breakout line. So I'm going to call it BL. Okay, this multi-year breakout line was tested once. Could very well get tested again. Not a guarantee, but very logically should get tested again. So if 2120 is tested and Art Cashin comes out there and all those gurus, guys who seem to be mostly bearish. I very seldom, I know the gentleman, I've had drinks with him. He's a great guy. It's got nothing to do with anything. But those guys are materially bearish most of the times. They have never told us when to buy. They've never told us to buy the Brexit lows. They've always said wait and see, wait and see, wait and see. Well, by the time wait and see, the markets are up here. So where the heck do you make money? So saying all that, they'll be screaming about the fact that 2120 is the level, but it is a level. It's a powerful level, and that's the level where the market broke out back in July. Okay, the week of July 4th. I said, don't short the market. It goes, and I was dead right because that's the week that it broke out. Okay, so if this tests that, is it possible that we basically do a dragon bullish formation, which I've shown in my other charts? Absolutely. These are enormous amounts of money for swing traders. While they grit their teeth and basically buy some long calls going out a week, 2 weeks, not too far out, and basically sit there. Or buy a little bit, buy the pullbacks because they know this is going to happen. The problem is we never exactly know. But patterns do replicate themselves. I say that with full certainty because I have seen it happen over and over and over and over again. I cannot convince anyone, but that's just the way it works. If we break 2120, see you later. We got a whole bunch of levels down here all the way down to 2000. Do I think that might happen in the month of October? Personally, I doubt it. I think this happens in the first week of, who knows? I mean, this October is different because of elections. Are elections November 20th or the 8th? I'm just kidding. Didn't Trump say it was on the 28th? We don't want to be 20 days late for the elections, right? So it's November 8th. So saying all that, is it possible that we break down because the market's freaking out over whoever's coming to office? It is very possible. But barring that, this uptrend, this breakout of this multi-year breakout line should hold. If this holds, is it possible that we have a pretty powerful rally all the way up? Maybe. Maybe. Okay. Or maybe they reserve that for after the elections. Whichever the case, this level has to be considered as a major support. We're tactical players. We're not asking to run to the moon. But if we do get there, you buy pretty heavily. Period. That's it. And the sooner we get there, the better off we are, to be honest with you. Now saying all that, this is the short-term picture that I want to show you all. And I know I keep on posting all this stuff during the day, but I just wanted to take this few minutes to explain to you now. We have a green doji. The last time we saw a doji, which was a red one, was right here on the 14th of September. Algos work on exponential applied math, okay? Which is not the domain of most traders. So patterns are another thing that they're watching, but they're not watching with big Google goggles on or whatever, you know. What do you call them? The Google what? Google glasses. They're doing it by looking at, you know, the numerical interpretation of each candle, because each candle is a set of numbers. So last time we saw a doji, and this is just my explanations, okay, was back on the 14th. We went down a little bit after that, and then on the 15th, we had a mother of a rally. Now remember, this volatility came about, and I'd like you guys to see, what date was this? Can somebody tell me? Let's look below. It's right there on the screen. Look down here. What date was that? Huh? Can somebody tell me what date was this, that we had this massive red candle?
September 13th.
Correct. This was September 9th. September 13th. What was this? This was September 14th. What happened on September 15th? We just took off. We had a minor consolidation for the next 3 days where people were freaking out, and then we took off again. This is known as a bull flag. You can draw it on your own screens by simply doing this. And at the time it was forming, I showed that too. That's a bull flag. Okay? And then it took off. Now, if it had given back more than 50% of the move, then we would have come back and tested the lower end. We didn't. So always the middle of the month. Okay? So today is the 12th. The 14th is a Friday. The 5th, there is no 15th or 16th because that's a weekend. There's a 17th on a Monday. Is it possible that we have a face-ripping rally by Monday? Is it possible that Yom Kippur, which is a high holiday, a Jewish high holiday, ends today? I know there's an old saying, and believe, I mean, it's not like, you know, people trade off that, but it's something that's respected. They say sell Rosh Hashanah and buy Yom Kippur. Google it and see it. So today is, I believe, the end of Yom Kippur at sundown. At sunset or whatever, sundown. So, so the bottom line is that, is it possible that if this doji that we're looking at, which is certainly not negative, let's just put it this way, certainly not negative, regardless of whether that the market closed up only 15 points after being up like 45 or whatever it was. Is it possible that it's going to try to attempt to get above 2150 and enter this triangle? This is a triangle that I keep on showing. We broke below the triangle. Yes, it's very possible. The other thing that I'm noticing is, of course, these internals that I just showed you. So be prepared. Some people who are overtly bearish will tell you, and rightfully so, that look, the 50-day moving average, which is moving sideways, the 34-day moving average seems to be crawling down. I said, okay, that's fine. because the 50-day moving average so far has not curled down. When that curls down, that's a given that every single bump in the market needs to be shorted. It can happen, but the 50 and the 30-day moving average, and I know these might sound like a little bit esoteric and, too wonky and, well, too boring for some people, but they do matter to when you're trading. So you don't, so that you don't keep on asking yourself, well, is that a buy? It's up $5. You know how many times I wanted to buy Amazon today? Because it was just ripping. It was up almost $6 at one point, right? 5 and change, 5 and 9. Stopped myself because I kept on looking at how overbought that stock was. And yes, on a good day, it'll be up another $10. But at least for today, I didn't have to deal with buying it on a runaway breakout and then sitting there by the end of the day saying, what the hell happened? Okay. So this doji possibly can go, in my opinion, will do, retest the 34 moving average as 2160 and then the 50-day moving average at 2166. Even in a downward sloping markets, and please mark this because it's a simple thing. Markets like to retest the moving averages. Anytime you move too far away from the moving averages, you revert back to the mean. I know I've talked about this hundreds of times, not hundreds of times, but at least 50 times since I started my service. But the more you, as you deviate from the highways, which are the moving averages, you will revert back to the mean. One or the other, it's going to happen. This is a standard deviation of almost -3. This was a standard deviation of almost minus, I would say, 4, 5. This was a standard deviation of almost -9. Look what happened. Did anyone ever imagine? Did you hear that from the Cashins of the world or the smart, gurus in the world that the market was going to turn from here? No, it did. And it did fast and furious. Mean reversions always happen. So given where we are right now, we could fall a little bit more, but the market will revert back to the mean just to retest it. So whatever the 34 and the 50-day moving averages are, you can rest assured that's where the market will retest. That's a decent sum of money if you play it, on a tactical basis. Period. Now let's take a closer look on what's happening so we can see on the 1 hour charts. So here we have the 1 hour chart. So this is what happened today with all the drama that happened. If you really take a look at it, it's really not that bad. This is where we were yesterday at 2 p.m. Nobody would even touch the market. We saw a big reversal candle, carried on. The market closed here at 4 o'clock. We were at 2136. Middle of the night at 10 p.m. I'm sorry, middle of the night. This SPX obviously doesn't show middle of the night. We're actually higher up. So this particular pattern that you're looking at it is possible that this gap up here gets filled rather quickly. Now, whether it gets filled by Friday or by Monday or Tuesday, I don't know because there's a good amount of margin calls that need to be settled. However, this pattern, this is a consolidation right there, just like that. Either can completely break down and create a double bottom, in which case you need to buy pretty aggressively. I said it yesterday, and I did it myself. You got to be aggressive of tactical bottoms, which has reversal candles like that. You don't want to be, that's fine. I'm not here to guide you on what you want to do. But these are the points of maximum money making at the points of maximum fear or maximum whatever it is out there, pessimism. So if the market gets back towards this 2128 level or so and creates, again, it has to create a reversal candle, then you got to buy it because within half an hour, within 15 minutes, within the early part of the next day, you are going to make some decent money, just the way it happened here. So whether this happens, I don't know. It's a possibility. Will this consolidation, it's like a cup and handle, break out and head towards entering the channel over, I'm sorry, the triangle over 2150 is also a possibility. If it breaks over the, enters the triangle, this is the triangle, it looks more like a rectangle because, you know, I zoomed into it, then you're going to close the gap here at 2162. Most retail traders, unfortunately, will start getting excited to buy the market at these levels. What can I say? Don't do it. Because by that time, it's way too late. This is the point of maximum profits. Now, somebody might say, hey, I can short the market from 2139 all the way down to 2128. I said, yes, you can do it, but you better be quick because whatever's going to happen is going to be very quick. Period. It's going to be very quick. So just be ready for that. There's different ways to skin a cat. You can wait, cost average down, and buy here, or you can short hard but be very quick in taking these this 11 points on the S&P if it gets there. Given what I showed you on the internals, to me, it's a bigger risk trying to short the market hard at these levels unless everything's falling apart. That's a different story. All right, and trying to the risk is higher to really short that hard rather than to basically try to make some money on the long side. So different ways to skin a cat. You can leave money on the side and say, okay, I'm going to buy a call here at 4. If it goes down to 2, I'll add some more here, bring your cost down to 3, and then as the market reverses, like it did here, you basically sell it. You know, with your cost average at 3, you can sell it at $6. But you got to be also quick on that too. So that's pretty much what's going on right now directly in front of us. Now, everything that's in front of us is also getting affected. However, I want to be clear. Individual stocks are singing their own tune. A lot of them. All right? A lot of them. Now, that let me just follow up what I'm showing with this. Oh, I forgot to show you some of the most important stuff. So this was hourly on the S&P 500. Everyone's like, oh my God, you hear a lot of comments like, you know, and there's nothing wrong. We're all human. Like, oh crap, look at the market. You know, it's just, you know, finished or whatever. Like, geez, you know, hear that. Look what's happening on the internals. Ladies and gentlemen, I wish we were all really robotic. Look, I'm not even. I try my best. I'm a heck of a lot more machine orientated with my brain and try to exercise patience and discipline than most people out there. But we're human after all. Look at what's going on here. You think it's just going to go like this and crash? That's a low probability move. The higher probability move is the candles are going to go positive till about 100. So you got roughly this much. On a weak market, the candles will go positive fast and then hit the 100 level on the McClellan oscillator. Even here, from this point here, the candles went positive for a whole bunch of days, even as the market was starting to pull back. Whichever the case, on the second or third McClellan oscillator candle, you want to be selling because that's when sort of the mini euphoria sets in, and we all are held hostage to looking at prices going higher or lower, depending on the position that we're in. We all get excited. Oh my God, here's the price going higher. You know, let's add this and that. We're all guilty of that. But we need to stop thinking like that. We really do. And it's really, really hard, believe me when I tell you, because the chart patterns are looking good. Things are moving on a particular stock. Oh, yes, it's going to move. Look at that. You know, everyone's looking and you start to see, you guys start to get all kinds of like, you know, alerts from different services like, yeah, sweepers are coming in and stuff. It doesn't matter. You have to follow the internals. This internal overall on the 1 hour side is looking pretty damn good. Despite all that minor pullback at the end of the day and stuff from, and this is purely margin selling. Believe me when I tell you, margin selling starts off at 2 o'clock generally. Unless you get a big move up at the first part of the day, the margin clerks will come in. And these are institutional margin selling. So it's not like a puny, I'll sell you $2,000 or $3,000 in margin. You're talking 10 million, 20 million, 30 million bucks. Okay, so they'll come in latter part of the day if the market's doing well, and they'll do chop, chop, chop. So these 3 candles that you saw was purely because of that, period. I've seen it happen in action. And this is exactly what they do now. So saying all that, this is certainly a positive divergence. Let's see how it works out. But generally, it just doesn't stop, crash and burn, and reverse that quickly. It generally has a momentum, and then it pulls back. So that's where we stand with the SPX. Now, let's take a look at. Oh, sorry. Then I'll take a few quick questions. And all right, so here we have the 1 hour on the E-minis. Here's the difference. The E-minis are traded by a bunch of machines and a bunch of gamblers. Futures traders are the biggest gamblers in the world, but when you talk to them, they never lose. Look at all the write-ups on the E-mini stream or on stock twits. They're all right all the time. Amazing. Okay, and good for them. You know, maybe they're all living in castles worth $100 million, but they all seem to be right all the time. E-mini traders move on pure momentum. Some of them are good with the levels. Some of them are just purely jumping on the bandwagon. So saying all that, nothing bad or good. That's just the way the beast works. Despite this pullback that we saw, this is at 4 o'clock, okay? This is at 4 o'clock. That was the last minute sell, so they're pushing it down a bit. Now, E-minis are also traded very actively from on the Globex, which is the global markets. That's why sometimes early in the morning when I'm waking up, you know, I put it out there. But looking at this pattern here, I would say that for swing traders, this tells me that these histograms will go positive. And when these histograms go positive, you get that big burst of energy, and these candles at 2 o'clock, 3 o'clock, 4 o'clock, basically you get to move up. So what's the level that you should watch for on the E-minis? And it's important that you take that you quickly look at them during the day. Is this dotted line. I do all the hard work for you by showing all the levels. All you got to do is monitor it. This dotted line is the VWAP. Want to know the definition of value weighted average price? Do that on Investopedia. But so basically, we had this. So does this mean that we're going to come down and test 21.21? It could very well happen, believe it or not, tonight. If it happens tonight in the overseas markets, that's actually a plus for us, because that means this pattern has now, what I explained earlier, has reset itself. And if this pattern resets, you're going to get a bounce from this 20. Let's say the market basically reset and opened at 21.20 on the E-minis tomorrow morning, which means that we would be down about 6 S&P points at the open. Nicely oversold, and right here. Perfect buying opportunity for a quick fat scalp trade, probably for the next hour. You could make yourself 40-50%. Now, if it opens up here, and the internals are, forget the volume here. This thing, which is oversold now on the 1 hour basis, right? This is the 1 hour chart, is all the way up here again. You have no choice. You have no choice. You gotta, whatever you gotta sell. If you're an active trader, you cannot be buying heavily overbought 1 hour positions. You want to look for the oversold conditions to get in. Now, on certain days, the markets are so strong, it doesn't matter. Overbought positions stay overbought for hours in a row. We've gone through those. And you just can't seem to get your hands on anything because everything's moving too fast, too quick. So I'd rather not be a buyer in those type of markets. I'd rather be a buyer in this type of market that we're dealing with. So that's pretty, so that kind of sums it up. Now, if with somebody keeps on practicing these things or looking at them in between their own style of doing things, everyone's got their own style, okay? And I'm not going to be here to change their style of how they look at things or how they trade things. I'm just giving you sort of my version of what's worked. Doesn't always work exactly to my timing, but it works. It works pretty damn well. So saying all that, this pattern here, once it resolves here, and I think it will, would set us up for a sharp move higher. These 50 and the 34-day moving averages constantly keep on acting as resistance on a falling market. So you have to monitor them. So if you're going to buy at 21.20, let's say, and then it goes to 21.34, that's 14 handles on the S&Ps, on the E-minis. That's almost the 14 points on the S&P 500. You better take profits. But you got to keep an eye on your screen. If these lines start to turn up, the 50 and the 34-day moving average, that's a different story. Chase them. Because if they start to turn up, that means things, the trend, the intermediate term trend is changing. You don't sit there and say, oh, it's, I'm going to sit around for a pullback. You chase them and make more money. And that's just the way it works. Now, right there in front of us right now, this is the 1 hour chart, right? So you want to take a closer look at what's going on. So this is your closer look. Seems like a long time ago, which was only on the 10th. Oh, it was just yesterday. Jeez. 2163. Now we're here. And looks like we're heading down. So bottom line is, once you kind of zoom back, then you see things in a clearer light. 1 hour the 15-minute, deeply oversold. 15-minute today, as the markets were rallying, got overbought nicely. So a lot of people ask me a lot of times, hey, what time frames are you looking at? I'm looking at all different time frames depending on how much money I have in that trade and how long I want to keep it. It's really as simple as that. If I'm going to do a fast trade, I'm going to look at a 15-minute real fast and see whether or not I'm starting to see reversal candles. This was 2:15 yesterday. I was looking at 15 minutes. I alerted everyone what's going on. Then I showed the 1 hour. The 1 hour is more reliable because that means that there's some real buying going on. But the 15 minutes, within 15 minutes, between 12:30, okay, for between 2:15, and all this matters to you all because whether you're trading stocks or whether you're trading SPX calls or puts, it does matter. So that's why I'm covering this. 2 o'clock, between 2 o'clock and 4 o'clock, the markets rallied from 21.20 up to 21.32. Pulled back a little bit and went up to 21.40. So we rallied 40 S&P points. Not that anyone will feel that till they traded it. We rallied 40 S&P points. That's 40 points. It's like telling you, hey, let me give you a stock and it's going to rally 40 points. Come on. It doesn't happen in a straight line, but it pretty much happened in a straight line. So you got 40 points here till that actually happened overnight, okay? So, but we got, by 4 o'clock, we had 2120. Yeah, we had about 15 S&P points right here till 4 o'clock. The calls that were bought around $1.40 closed at 247. Don't you think you should take some profits? What can I say? I mean, especially if they're expiring the next day. Do what you need to do. You take some profits. You leave a little bit out there, so you don't lose the whole thing. Unless you think the market is just on a one-way runaway train, when it's never. And just the way it's never on a one-way runaway train down. So here the calls were $1.40. Can somebody mute their phone or do whatever? So between 2 and 4, they went up. They went up to about $2.47.
哦，呀，可能是不是那个水分过得满了？我看看。
All right. So that's pretty nice. That's pretty nice move. If you bought 10 calls here, that's $1,400. You sold them at close to 20. Please, can you mute your phone? So you could have made $2,500. Now this happens almost every other day. Now, if you bought 5, Well, you know, I'm not going to be babysitting you on like easy math, you know. So if you put $700 here, okay, bought 5 contracts, then you'd be selling at at close to 1,300, or let's say 1,200, 1,250. So do what you need to do. I'm showing you the nitty gritty of how things happen. So sitting around waiting for that big flower to blossom is just not going to work in this type of market, period. Because there's way too many things going on outside, which is making rational moves difficult. A rational move would be this. Watch. Little pullback and then move up. This would have been a rational move in the market. Instead, the market hit a roadblock here, couldn't enter into the triangle, you know, consolidation triangle, moved around, tried to go up there right after the Fed, and then just gave in. And now most probably will test this and then make another attempt at testing that, you know, testing the pivot, which it keeps on failing. So which brings me to my other point here. Please. End of the day, I take a decent amount of time, because putting out all these charts and stuff really isn't fun. Let me just put it this way. I love looking at charts and figuring out what to do, but putting it for all of you, but I have to do it. That's my job. So the point is that from a Twitter standpoint, one second, there are, bear with me, these charts are very important because it gives you a little heads up on what is going on. And I started putting all these individual charts, right, on how the market closed that. Forget the CSX right here, right? So take a quick look at them at end of each day. I put the levels down. This was the tough pivot resistance. And intraday, you could have made 50 to 70% on your money, or from the lows yesterday. Then this particular chart, which basically is a little bit more complex, but every line that I've drawn, that's exactly where it seems like the market went and rejected, and then let's see what happens. These are the buy and sell zones. You can write them down on your own or print it out. And then you have the slow stochastics, which is suggesting nicely higher. Why these things do what they do, I have no frigging clue. These are all mathematical formulas. But I know one thing: when the slow store starts to move up, that means the market wants to go higher. And that's it. That's, you know, it doesn't mean it's going to do it in the first hour or the second hour or the third hour, but this is definitely looking good. The stochastics got overbought, pull back. I know it sounds repetitive. That's just the way things work. There's nothing wrong with how the market closed here, and this was at 4. Nothing wrong the way the market closed here, moved up. Here's the pivot, shot up above it, looked pretty damn good, gave back in. So anyone who bought a complete breakout thinking that it was just going to, you know, go higher might be delayed with their results maybe for another day. But so far, nothing is really that wrong. And this is, of course, the quad version of the representation on the chart. That's the algo HFT charts, as I like to call them. They're very, very accurate. I put out the basic off my, you know, on offinvesting.com. This is what it was looking like. They looked a little bit different by the end of the day. This was around 348, I believe. So in 12 minutes, the world can look a little bit different. It doesn't matter. This was your 5 minute, this was your 30 minute, and this was your thing. And then, of course, I had the different stocks and all that stuff. So anyway, so what it comes down to, and I'll certainly take a question, you know, a couple of quick questions, is it's an extremely difficult market. So it doesn't matter how good my chart setups looks or how good your chart setup looks, it might not just work out as quickly as we would like. A lot of swing charts are very intact, believe it or not, but things can change. So what I would do and what I've been doing is keeping position sizes small, trying to be quicker on taking profits, being patient with some of the swing trades, and praying. I mean, honestly speaking, this is a very volatile market, and I'm showing all the different patterns and things like that. But don't expect each of those patterns to work out exactly within the time frame that we're saying. Saying all that, once we get this hump of mid-October out of the way, we should get a relief rally, and that's exactly what I'm going to call it. We should get a relief rally, which is going to basically be worth some real money on the long side. On the short side, if we break 2020, we could make some nice change as the market falls towards, 2120, as the market falls towards 2100, and it doesn't stop at 2100. It'll fall towards around 2080, 2060. So just keep that, in mind, because that's exactly what they're going to do. Now, these two charts are the ones that are controlling trading, and I've shown that clearly. That's your British pound. Let me get all the lines out of here. I don't know how to really read this chart other than to say that the Darvas box is down here. It was starting to move higher and then gave in. This was the big flash crash. There were two major flash crashes on the British pound. Right here on what date? On the 24th of June. That was Brexit. That was the Brexit flash crash. And then we had another flash crash which seems to have reversed itself, the one that I showed the middle of the night at 3 a.m. And that one is the one that's playing out right now. The downtrend is still on, but here's the difference between my service and other people. Where the mean reversion is up here at $1.30. I believe the British pound is going to mean revert. It's going to happen in the middle of the night when they open their markets and stuff at 3 a.m. in the morning, and it's not going to give you a chance to really get in. So not get in. I mean to really participate on any type of big move that comes overnight on the S&P futures, because this is the one single most important chart that is controlling the markets right now. The collapse of the British pound and the subsequent corresponding rise of the dollar. Now the dollar has a round number to go to, and that's to 100, right? So right there at 100. I don't know if it's going to go there, but this is the dollar chart. And if you had a stock chart looking like this, you'd probably say, hey, I want to buy it. So that's exactly what's going on. This is your highs on the dollar going back to February of last year. Now remember what happened of February, of this year. Does anyone remember what happened in January of this year? Anyone remember? No? No?
Market crash.
Exactly. The market crashed big. All right? And that was your dollar index at 100 back in. What happened in February 8th?
Yeah, hi. I forgot to pay my water bill and my water was terminated. I just paid it by phone.
Okay,
so
excuse me.
So
I'm going to shut your water off right now. I'm going to completely shut your water off right now. I think I shut our water off.
Oh, the reconnection fee?
Okay, whoever it is, can you mute your microphone, please? Because I am definitely shutting your water off.
Oh, $40.
Oh boy. You can't hear me. All right, let's continue. Technical.
It's 6550 North St. Gabriel Boulevard.
Okay, let me see who it is so I can mute. I think. Okay, Sue, can you mute your microphone? Okay, I just muted her from here. All right. So bottom line is this pattern symmetry, if it resolves itself, then we got that another 100 points down in the market, which will happen by Friday, because it's just the way things work. They're all correlated, right? So if you look at this pattern here, and by the way, I did not shut her water off, okay? So hold on 1 second. So if this pattern, convoluted pattern, reveals itself, it's more like a big cup, right? then the dollar index, that's what they keep on talking about, is going to go to 100. If the dollar index goes to 100, the pound's going to flush itself down to about $1.18 to $1.17. You better book your tickets to London. It's going to be the cheapest, and switch some dollars into pounds, because London is one heck of an expensive town. All right, great city, very expensive. I don't know how the heck they live, you know. Been there a lot of times. It's so expensive overall compared to what we pay here. I don't know how people afford it, but they all seem to be looking dandy and look great, right? That's Europe for you, and England. So anyway, so bottom line is it's going to plummet more. Big DEFCON 5 all over the media. The dollar's going to hit 100, and I think that'll be pretty much it. Now, if the dollar does want to go higher, then it's going to be a big cup, a nice handle, probably pull back a bit before it goes higher again. But in general, a higher dollar is not necessarily bad if we keep on getting stronger, if we keep on seeing underlying stronger economic numbers from our end. So it's not bad to have a stronger currency and a stronger economy. Just remember that. Saying all that, the British pound will not keep on going down lower and lower, because the Bank of England will intervene and prop up their currency. And a lower British pound is good for their economy, just the way a lower currency is great for the economy, because their exports are cheaper. So if they manage the Brexit good, and they revise a bunch of their trade pacts with their big export partners, which happen to the United States, which happen to be Japan, which happen to be China, which happen to be the Middle East, then they will be fine, because fantastic British produced goods are going to be priced cheaper because of the lower currency, and it's going to boost their economy. Everything is supply and demand. I don't want to get into it too much, but that's just the way it works. A cheaper currency increases exports, because foreigners can then buy your products at a cheaper price, period. Why do you think markets freak out when the dollar's rising that quickly? Because our goods, whether it be aerospace or technology, or whether it be medical products, or whether it be defense, we are the largest defense, arms exporter in the world, believe it or not. And for everything from missiles to planes to bombs, name it. So the bottom line is the aerospace industry and the defense industry, things will be a little bit cheaper. So, but when the dollar goes higher, they're far more expensive for others to buy. And secondly, the most important reason is that when the dollar goes higher, all this emerging market debt that's out there, that's denominated in the US dollar, because the US dollar is still king and will remain king for at least our foreseeable lifetimes. Okay, obviously it's priced higher. You got to pay back in dollars. It costs them a lot more. It's really as simple as that when it comes to the economic side of things. So we don't want a runaway dollar. We need a stronger dollar, no question about it. We don't need a runaway US dollar, because that's going to affect global emerging markets, which is not good for anyone. The blowback hits us too. So I watch this very carefully these days to see what's going on. Any reversal from a trading standpoint, so you want to use the 1 hour and the 15-minute, any reversal, we were starting to see that. If you zoom in, you start to see it more. It's kind of nice when you start zooming in. You got a V-shaped recovery, you got a pullback, which started at around 4 a.m. this morning. Then you started to pull back a little bit. So you said, okay, I'm going to watch the 15-minute. Perfect. Oops, sorry. 15. There you go. All right. So market today is Wednesday, right? So as you can clearly see here, this was Wednesday. So the markets, today was Wednesday, right? Okay, that was 4 in the morning. That was when we were starting to go up till about 2:15. Guess when our market started to pull back? Pretty much around 2 o'clock. Yes, that's exactly, because they're all correlated. And once the market, once this started pulling back from 2 o'clock, right there, guess what happened? Our market started to pull back. Guess what happens? It's all interrelated. And I can't even give you all the players in it. The margin clerks started to sell. They're like, oh boy, here we go down. Let's take our cash while we can before those asset prices go down. Because after all, how do margin clerks recover their institutional margin calls? By selling stocks and equities, which bring in money. So if they can sell Amazon $5 higher, why the heck would they wait to sell it $1 higher? Period. That's really as simple as that. So that's exactly when they start to hit. And that's when the hedge funds pile in and all kinds of stuff happens. So that's it. So there's nothing wrong with this. I think this is going to hold itself around here, around the $1.20 level on the British pound. And I'm no currency expert, but I use them as a proxy. This is a beautiful double bottom and a very sharp move of the 120 level. And if you futures were up quite nicely till about I think till about 2 o'clock in the morning or 3 o'clock in the morning, because the British pound was moving. So that's it. Now, any questions? Let me see here. I think for the session, very useful. Appreciate that. Yeah, that's it. It's just a quick update on things. By the way, I think House asked me about Clovis and stuff. I have enough charts out there. You just got to take a look at it. CMG, the same store. Did you say, Jules, did you say, oh my God, or CMG? Oh, you said OMG. Okay, that's about the water supply cutting off? All right, good. Lamo, which is the house, at Tesla and Clovis. I have enough charts out there. Please pull it up and do it. Don't let me do this again. Okay, it's there. CMG swing wise looks pretty damn good. It seems to be holding that channel, that consolidation channel that I keep on showing. And listen, guys, let's do our best in this very difficult market. I'll put in my 2 cents. You guys put in your input, and we'll do it together. Okay, that's your quick update for tonight. Get used to this volatility. I don't think we're in a meltdown. I do think that the 2120 level will hold. Let's have some cash on the side. I know it's difficult. But when there are tactical trades put in there, whether it's a Buffalo Wild Wings for $5, or whether it's a Clovis for $3, or whether it's a Tesla for a quick 70% gain on cheap calls, or Apple, which worked out fantastically, take them. Put a little bit in and take them. Nothing is for granted in this market, but nothing is that crazy either, regardless of all the garbage that you hear in the media. Okay, so we should be fine. And happy Yom Kippur to all who observe. See you guys all tomorrow. All right. Thank you and good night. Thanks, Jules. Bye. Bye, Xita.